Everything you've been taught about trading is wrong. You've been told to try and predict the macro environment and memorize different chart patterns, try to predict where the S&P is going. But get this, trying to predict the future is a mathematical and a statistical death sentence. Your perfectly drawn trend lines are being used as a trap by the large players, as a roadmap for how to take your money. I've been a hedge fund manager for over 25 years. I was featured in Jack Schwager's Unknown Market Wizards book. Today, I'm answering exact questions on how to get an edge in the market. Stop guessing, kill your ego, and put a mathematical edge back in your trading so that you can earn profits over time. Because predicting the market means you're trying to predict the future. And nobody in history has ever been able to predict the future over time. You might get it right once or something or get it right twice, but over time, trying to predict the future is an impossible task. So if that's the way you think you're going to try and make money in the markets, you're going to fail. I think that a beginner trader thinks that if he studies and reads the news and understands the news, that gives him an edge in the market. But it doesn't, because there are millions of people out there who are reading the news and understanding the news. And therefore, that news is already discounted into the price of whatever asset it is you're trying to trade. I think that a beginning trader doesn't really understand the concept of the market being a discounting mechanism because they haven't been involved in it. They think that it's like other industries where if you just learn the mechanics of the industry, then you can be successful in it. If you learn how to be an electrician, then you can go on and become an electrician. But as an example, if the electrician business was a discounting mechanism, then if electricians were making good money and everyone decided to become an electrician because of that, then suddenly there would be an oversupply of electricians, okay? And the price of electricians would come down and the money you could make as an electrician would go way down. That's what the discounting mechanism is, right? If there's a company that's doing very well, well, then everybody starts to find out that it's doing well. Everybody buys the stock and the stock price goes up. Then the fact that they're doing well has become discounted in to the price. And therefore, the chance for future profits dwindle. That's what discounting mechanism is. They're acting on information that everybody else can see and everybody else is acting on. So therefore, the edge of acting on that information is very, very small, if not non-existent. So in my view, finding an edge is about being contrarian as possible. First of all, because we know that somewhere between 90 and 95% of traders will lose money over time. So to keep it very simple, if we could figure out what those 90 to 95% of traders are doing and we could do the opposite, then we could make the money that they're losing. It's that simple. We want to make money in this game. That's the goal. Not to be smart, not to predict the future, not to prove anything. Just make money. And to me, the low-hanging fruit is if a large percentage of people are losing money and those people are all doing the same thing, then the odds of going opposite them should work over time. That's what I think you need to be focusing on. Yes, sometimes the crowd makes money. That's what keeps them coming back, right? They get that one winner and they think that they can do that again and again and again. You know, just because 95% of people lose money trading doesn't mean that they lose on every single trade. In fact, they don't lose on every single trade. Otherwise, they'd be gone very quickly. So you have to understand that even if we are to do the opposite of what 95% of the losers are doing, every trade's not going to work. So that's where risk management and discipline and the ability to take losses comes in. A crowded trade does not mathematically guarantee a reversal. All it's really trying to do is measure the risk reward of a possible trade. Right? Just because a trade is crowded does not mean that it's going to reverse. And even if it does reverse, it doesn't mean that it's going to reverse right this second. It just means that should it reverse, the move can be very big because you have so many people trapped on one side that when it reverses and they all have to get out, the lack of liquidity on the other side can push the market to move a lot. That's really all a crowded trade does. And that's really all we're trying to do is getting to situations where the reward is much bigger than the risk. I think as you start to look at positioning and start to observe how markets are moving based on where they're positioning, you will see just how powerful it is. And it can't help but to change the way that you look at markets. We have thousands of people that have joined the Crowded Market Report, many who have sent me messages saying that they never thought of this before. They were never thinking of positioning. They were just looking at charts or they were doing fundamentals and all that. And now that they see the importance of positioning in live time, you know, that it has benefited them immensely. So if you'd like to join the Crowded Market Report, the link is in the description. So the way that I enter a market, the trigger that I get to actually put on a trade once it is crowded. I call it news failure event. Essentially, first of all, no matter how you trade, you want the market to confirm that what you were thinking or what you were looking to do is correct. So how does news failure confirm it? If I see a market that has shown that people are massively short, I start looking into why they would be short. What is the news and the narrative that has been driving the market lower? Let's say, for example, it's interest rates are going up. Let's look at a very recent example, the war in Iran. The fact that oil prices were going higher because of the war, which was leading to the possibility of higher interest rates and higher inflation, was pushing the stock market down. That was the narrative. Well, on April 2nd, heading into a long weekend where the uncertainty of war was very high, oil prices went up on that day over 12%. It was one of the biggest up days in oil for the entire war. And the stock market took that poorly at first, but by the end of the day, it actually closed up on the day. That's a news failure event. The reason the market was going down happened again today, and yet the market didn't go down anymore. That's the market confirming that the contrarian trade is good to go. Yeah, it's all about letting the market tell you when, letting the tape tell you when it's acting right. Instead of just buying something that's going down and buying the weakness and buying the weakness and buying the weakness again, it's okay, here's the market confirming that it has stopped going down. So that gives you a much better risk reward entry point. So the good thing about these news failure reversal days is it not only gives me my entry, the market telling me, okay, it's a good risk reward to get in here. It also gives me a great stop loss point. So for example, here's a market that's been going down for a long time on certain bad news, and that bad news was confirmed today and the market can't go down on it anymore because somebody waited. The market's been going down for months. Bad news came out today and somebody waited to short it on that bad news. The market's not that easy. That person should never make money. So if they do in fact make money, then the trend is very strong and I don't want to be fighting it. So I buy on that reversal day. The low of that reversal day is my stop. By definition, I am picking turns. So if we make a new low, I did not pick the turn. I'm wrong, right? So therefore, that's where I get out. So it gives me a great stop. I know my entry, I know my stop, I know how much I want to risk per trade, so I can then back into how I'm going to size this trade. So if it ends up being a loser, I'm going to lose exactly what I expect to lose, or at least very, very close to what I expect to lose. This is a common thought, the win percentage rate. And I think it's probably the most misunderstood and one of the most dangerous statistics out there. I can tell you that if you have an 80% win rate, it's not that hard to do, okay? You just buy markets that are very oversold. And if they go down more, buy some more, and eventually they'll bounce back to your average cost. In casinos, they call this martingaling. And it will work 80% of the time. And that feels great. The problem is the other 20% of the time. Let's say that some stock is eventually going bankrupt. Well, if you're buying it because it's oversold, you would have been buying it the whole way down, the whole way down, the whole way down. Now you have a very big position in it. It goes to zero, you're blown out. That's what happens the other 20% of the time, right? So you have a high win rate, but you have a negative P&L. It's exactly what we don't want. The only thing we care about, the only statistic that really matters is your P&L. Is it positive or is it negative, right? And if it's negative, then if your win rate is 99%, that's no good. And that can happen. If you bet all of your money on every trade and you make on 99% of them and then you lose on one, well, if you bet all your money on it, then that one means that you blew out and you're at zero. So it's not about win rate percentage, I promise you. And this is something else that many good traders who I've spoken to and interviewed have said, that over the course of the year, 80 to 90% of their P&L will come from somewhere between 10 and 20% of their trades. So it's not about win percentage. It's about making a lot more on your winners than you lose on your losers. Get out of the trade. I mean, that's the definition, right? That's the definition. You know why you got in. You know where it's wrong. And if it's wrong, then you just take your loss and move on. They need to understand why they're sitting on a big loss. And the reason why they're sitting on a big loss is because they didn't take it when it was a small loss. And they need to start to define when they're going to get out. For every trade that you get into, you need to know where you're going to take your loss. Where am I wrong? Where am I going to take my loss? Listen, you can always get back in, okay? If you're convinced that this stock is going from 50 to 500 and you buy it at 50 and it goes to 45 and you take your loss. Okay, if it's going to 500, then you got plenty of time to get back in. You know, there's no reason. Being married to a position is the most dangerous thing that happens. I mean, Bitcoin recently lost half. There's a lot of people out there that think Bitcoin's going to 1 million, and maybe it is. is. But what I said the whole way down, and when Bitcoin was halving, there was no reason for it. Asset markets were strong. Bitcoin was seen as correlated to these asset markets. And in the meantime, Bitcoin just kept falling. So you could have taken your loss, gotten out. You can always get back in. If Bitcoin's going to $1 million, you got plenty of time to get back in, right? Get in when it starts to act well again. So that's the point. Don't be married to a position. If you're going to be right, you can always get back in. If you take one thing away from this video, let it be that ego costs money. The way to get rich is to admit that you're wrong and admit it quickly so that when you are right, you're not just making back losses, you're making gains. If you want to just stop being the liquidity for the people that are making money and start joining the people that are putting up profits over time, hit the link below and join us at Crowded Market Report. Stop trading the chart and start fading the crowd. See you in the next video.